The analysis of a market trend or an individual stock price trend is greatly enhanced when applying candlestick analysis or candlestick signals to the analysis of a trend, including the T-line. The T-line is the 8 exponential moving average. Very simple rule. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. As we can see right now in the Dow, we had a bearish engulfing signal, but over the last couple of days, they have not been able to really close the markets below the T-line. This tells us the probabilities are that we're still in an uptrend. The same scenario can be applied to the NASDAQ. Big bullish engulfing signal, close above the T-line, consolidation, but notice what's happened in the NASDAQ. They haven't been able to close it below the T-line. So the candlestick investor, knowing that the next pattern could be a J-hook pattern, will watch to see if there's a breakout of this little slow curve move. If so, we know the next move is going to be the same magnitude. But with more clarity, we can see that investor sentiment is not changing, just consolidating, because they haven't been able to close back below the T-line. Knowing that fact, if you're buying individual stocks like Intersect, notice where the reversal occurred, right smack dab off the 200 and the 50-day moving average, and then closed above the T-line. This stock is up 400%. So what are most investors concerned? Oh man, when should I take profits? However, there's a very simple technique. As long as they don't close below the T-line, you stay long. However, there is a simple caveat to that analysis. The further away you move from the T-line, the higher the probability they'll come back and test it. So that makes, when you're in an overbought condition and you start seeing candlestick sell signals and you've moved a good distance away from the T-line, the probabilities are pretty strong that you want to take profits on the first confirmation of that sell signal. That scenario can also be seen in the oil stocks. Whiting Petroleum, a kicker signal above the T-line. You can stay long until you see a sell signal and a close back below the T-line. Candlestick analysis is merely the graphic depiction of what's happening in human nature. And a very simple way to state it is that prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. Candlestick signals are merely the graphic depiction of what's happening in investor decisions based upon what they think are happening to fundamentals. The T-line is also effective for illustrating when a candlestick pattern is in progress. Micron gapped up after some buy signals in the oversold area through the T-line, came up, pulled back, and notice where it closed. It still closed above the T-line. When the next move started, that told us a J-hook pattern was in progress. Essentially, using the combination of candlestick signals and the T-line just puts you in a dramatically strong position as far as being in the right position at the right time. That'll be it. We'll see you in the chat rooms.